February 1st, 2026. Budget Day in India. The day Finance Minister presents the Union Budget. The day when import duty changes get announced. The day that can make or break India's jewelry trade. And it's also the day gold and silver crashed another 9%. MCX gold, down Rs 13,711 to Rs 1.38,634 per 10 grams. Silver, down Rs 26,273 to Rs 2.65,652 per kilogram. This wasn't just another down day. This was one of the steepest two-day sell-offs in the history of precious metals. Combined with Friday's carnage, the total damage is staggering. Silver down 37% from its intraday peak. Gold down 12% globally, the worst single-day drop since the early 1980s. But Budget Day adds a uniquely Indian dimension to this crisis. Bullion traders aren't just watching metal prices. They're watching Parliament, waiting for the finance minister to announce whether import duties will change. Because that single announcement can swing gold prices by thousands of rupees per 10 grams overnight. Today, we're dissecting the Budget Day massacre, revealing why import duty speculation amplifies volatility in Indian markets, exposing how jewelry trade is caught between global crashes and local policy uncertainty, explaining what the wide MCX gap means for traders who couldn't act during the weekend, and providing a survival guide for navigating the most dangerous day in the Indian bullion calendar. The two-day apocalypse, putting numbers in perspective. Let's start with the total damage over 2 days because the scale is unprecedented. Friday's carnage, silver, down up to 37%. Intraday gold, down 12% globally, worst since early 1980s. MCX participants stunned by the violence. Sunday's Budget Day continuation. Gold, down another Rs 13,711, 9%. Silver, down another Rs 26,273, 9%. Total two-day loss compounding into territory never seen before. The compounding math. When you have 2 consecutive 9 to 10% down days, the total loss isn't just 18-20%, it's worse due to compounding. Starting point, gold at Rs 193,096 per 10 grams, recent peak. First day, 12%, falls to Rs 169,924. Second day, 9%, falls to Rs 154,631. Total decline, Rs 38,465 or 19.9%. But the article states gold is now at Rs 138,634. That's a Rs 54,462 decline or 28.2% from the peak. This suggests the falls were even worse than the percentages indicate, or multiple sessions of selling have occurred. For silver, starting from Rs 420.48 per kilo and now at Rs 2.65,652. Total decline, Rs 154,396 or 36.7%. This is complete wipeout territory for leveraged traders. Budget Day. Why it matters for Indian precious metals. For non-Indian readers, Budget Day needs explanation because it's uniquely important for bullion. What is Budget Day? The Union Budget is India's annual financial statement presented by the finance minister, typically on February 1st. It outlines government spending plans, tax changes, import-export duty modifications, economic policy direction. Why bullion traders care specifically. The finance minister can announce changes to basic customs duty on gold and silver imports. This directly affects landing cost for importers, wholesale prices, retail jewelry prices, smuggling economics. The article notes current duties. Gold and silver bars are taxed with about 6% basic customs duty and 3% GST, accounting for the total load to nearly 9%. This is actually low by historical standards. The article mentions marking a lower rate than earlier years when duty stood near 15% and had propelled large-scale smuggling. Why Budget Day creates volatility. Scenario 1. Duties increase. If the FM announces duty increase from 6% to 10%, immediate Rs 3,000 to 4,000 increase per 10 grams. Jewelers rush to sell existing inventory before new rates apply. Consumers delay purchases waiting for prices to adjust. Short-term demand collapse. Scenario 2. Duties decrease. If duty drops from 6% to 3%, immediate Rs $2,000, 3,000, decrease per 10 grams. Jewelers holding inventory face instant losses. Consumers flood in to buy at new lower prices. Short-term demand. Spike Scenario 3. No change. Initial relief, but global price movements still dominate. Market focuses back on Warsh-Fed dynamics. The speculation alone creates massive uncertainty. Traders don't know whether to buy before potential duty hikes or wait for possible duty cuts. The jewelry trade dilemma, caught in the crossfire. The article asks a critical question. Left the market participants unsure whether the drop presents a buying opportunity or signals deeper trouble for India's jewelry trade. Let's explore this dilemma from the jewelry sector's perspective. The buying opportunity case. For jewelers, gold at Rs 138,634 versus Rs 193,96, peak, here in 28% discount. If you need to replenish inventory, this is much cheaper. Wedding season coming. Marriages peak in certain months. If duties don't increase, you profit when prices recover. For consumers, gold jewelry, 25 to 30% cheaper than 3 days ago. Making charges remain constant, so total savings even larger. Good time to buy for upcoming weddings festivals. Rupee gold typically holds value long-term. The deeper trouble case. For jewelers, inventory purchased at Rs 180,000 plus is now worth Rs 138,634. Instant 23% inventory loss on paper. If you sell at current prices, you lock in catastrophic losses. If budget announces duty increase, inventory loss becomes even worse. Cash flow crisis as working capital evaporates. For consumers, falling knife. Psychology. Why buy today if it could fall more tomorrow? If global gold continues falling, today's discount becomes tomorrow's overpriced purchase. Economic uncertainty. If metals crashing, maybe broader economy weakening. Better to wait for stabilization. The article captures this perfectly. Unsure whether the drop presents a buying opportunity or signals deeper trouble. This uncertainty is paralyzing. Jewelers don't know whether to buy inventory. Consumers don't know whether to purchase. The entire trade is in limbo on budget day. The wide gap down. What weekend means for MCX traders. The deeper fall occurred after Indian equities closed for the weekend, prompting a wide gap down on MCX when trading started. This is brutal for MCX traders because of the timing, the sequence. Friday close. MCX closes for the weekend. Gold at, let's say, Rs 152,345 per 10 grams. Weekend. Global markets continue trading. Trump confirms Warsh. Dollar strengthens. Gold falls globally. Sunday MCX open. Indian markets reopen. Gold gaps down to Rs 138,634. The gap. Rs 13,711 lower with zero opportunity to exit between Friday close and Sunday open. Why this destroys traders? Stop loss is useless. If you had a stop loss at Rs 150,000, it doesn't matter. Market opens at Rs 138,634, far below your stop. You get filled at the opening price, not your stop level. No exit opportunity. Unlike 24-hour markets, MCX closes weekends. You're trapped holding positions through global events with no ability to react. Margin calls pile up. Saturday and Sunday, your broker calculates unrealized losses based on global prices. By Sunday, margin calls are already waiting. For a leveraged trader, you bought gold futures at Rs 180,000 using 5% margin, Rs 9,000 margin. Friday close, Rs 152,345. You're down Rs 27,055, but still have some buffer. Sunday open, Rs 138,634. You're down Rs 41,366. You've lost 4.6x your initial margin. Your position gets force liquidated at Sunday's opening price. The wide gap down means there was no price discovery between Friday and Sunday, no gradual decline that let traders adjust, just a cliff. ETFs, the double whammy. ETFs experienced another round of resets in price after losing 15 to 20% on Friday. Let's break down what another round of resets means. Friday, gold ETFs in India fall 15 to 20% as MCX gold crashes. Weekend, global gold continues falling. The ETF's underlying holdings, physical gold, lose more value. Monday, when equity markets reopen, ETFs gap down again to reflect weekend losses. Total damage for ETF holders. Friday, 18%, let's say. Monday gap, 9% more. Total, not 25% in 2 trading sessions. But ETF holders couldn't sell over the weekend. They were trapped watching global gold fall, knowing Monday would bring another gap down, unable to do anything. This is why the article notes they're experiencing another round of resets. It's not one loss. It's sequential losses with no exit opportunity between them. For retail investors who bought gold ETFs at peak, investment made, Rs $100,000 in gold ETF peak. NAV, Rs 100, Friday close NAV, Rs 82, 18%. Monday open, NAV, Rs 75, 25% total. Current value, Rs 75,000. Loss, Rs 25,000. Many won't even know the full extent until Monday morning when they check their portfolio apps. MCX Limited stock, exchange profiting from volatility. Meanwhile, MCX shares dipped to 9% as exchange-linked volatility spreads across the market. This is a fascinating detail. MCX Limited is the company that operates the multi-commodity exchange. Its shares trade on NSE/BSE. Why did MCX stock fall 9%? You'd think a commodity exchange would benefit from volatility, more trading, more fee revenue. But MCX stock fell for several reasons. Market-wide risk-off. When everything is selling, even exchanges get sold. Clearing risk concerns. If many traders can't meet margin calls and their accounts go negative, MCX's clearinghouse could face losses. Regulatory risk. Extreme volatility might trigger regulatory scrutiny or new restrictions on leverage. Reduced future volumes. If this volatility scared retail traders out of commodity markets permanently, future volumes and revenues could decline. But there's a deeper dynamic. The article notes, exchange-linked volatility spreads across the market. This means fear about commodity. Market stability spreads to other sectors. If commodities are crashing this hard, what about equities? MCX as a proxy for commodity market health falls with metals. For investors holding MCX stock, this is bitter irony. You own the exchange hoping to profit from commodity trading activity. The biggest trading activity in history, from volatility tanks, your stock instead of boosting it. The import duty history. Context for budget speculation. The article provides crucial historical context. Duty stood near 15% and had propelled large-scale smuggling. Let's understand this history because it explains why budget day duty announcements matter so much. 2013-2019 era, high duties, basic customs duty reached 10% on gold, combined with other taxes. Total landed cost added 15% plus. Result, massive smuggling operations. The smuggling economics. Legal import at 15% duty. International gold, USD 1,800, O's, Rs 1.48,500 per 10 grams, at Rs $82. Plus 15% duty, Rs 20,275. Landed cost, Rs 170,775. Smuggled gold, same international price, Rs 1.48,500. Zero duty, paid smuggler's premium, Rs 5,000. Cost to buyer, Rs 153,500. Savings, Rs 17,275. 10% cheaper. At those economics, smuggling exploded. Estimates suggest 100-200 tons of gold were smuggled into India annually. 2019-2024, duty reductions. Government realized high duties were counterproductive. They didn't reduce gold imports. Demand is inelastic. They just encouraged smuggling. They reduced tax revenue, smuggled gold. Pays zero tax versus legal imports paying some tax. So duties were progressively reduced to current 6% level. 2024-2026, current regime, at 6% duty plus 3% GST or 9% total. Smuggling economics don't work. Legal imports dominate government, actually collects more revenue, lower rate X, higher volume. Budget day, 2026. The speculation traders are worried the finance minister might increase duty back to 8 to 10% to raise revenue, keep duty at 6%, status quo, further reduced to 4% to boost jewelry exports. The uncertainty is what's killing the market. Nobody wants to commit capital when policy could swing prices Rs 5,000, 10,000 per 10 grams in hours. The wedding season factor. India's gold demand is heavily seasonal, tied to wedding and festival calendars. Peak wedding months, October, December, April, May, varies by region and auspicious dates. Festival demand, Dhanteras, Diwali, Akshaya Tritiya, current timing, February. We're in a relative lull between peak seasons. This means less urgent demand. Families planning weddings in April, May aren't in panic buying mode yet. Jewelers can wait. No immediate need to stock up for wedding season. Budget timing is strategic. Government knows February is low season. Any duty increase now gives market time to adjust before peak season. This seasonal factor makes the buying opportunity question even more complex. If you're a jeweler, maybe wait until closer to wedding season to stock up in case prices fall further. If you're a consumer, if your wedding is in October, why buy now? You have 8 months. Prices might stabilize or even fall more. If you're a trader, low seasonal demand, plus budget uncertainty, plus global crash, dangerous combination. The crash happening in February, low season, might be less devastating than if it happened in October, peak season, but it also means there's less natural buying support to catch the falling knife. The smuggling economics reset. With gold at Rs 138,634, let's recalculate smuggling economics. Legal import, international, Rs USD 4,900 O's, Rs 127,000 per 10 grams, rough estimate. 6% duty, Rs 7,620, landed cost, Rs 134,620, smuggled gold, international, Rs 127,000 smuggler premium, Rs 4,000 cost, Rs 131,000 savings, Rs 3,620, 2.7% cheaper. At only 2.7% savings, smuggling barely makes economic sense given the risks, jail time, asset seizure, etc. But if budget increases duty to 10%, legal import with 10% duty, international, Rs 127,000. 10% duty, Rs 12,700. Landed cost, Rs 139,700. Smuggled gold, Rs 131,000. Savings, Rs 8,700. 6.2% cheaper. Now, smuggling economics improve significantly. This is why bullion traders care so much about the budget announcement. If duty increases, two things happen. Legal gold prices spike. Smuggling becomes more attractive again. Neither is good for the legitimate jewelry trade. What happens? Monday. The 3 scenarios. Let's game out what happens when equity markets reopen. Monday. Scenario 1. Budget increases duties. Announcement. Duty raised from 6% to 10%. Immediate impact. Rs 4,000 to 5,000 additional cost per 10 grams. Gold ETFs. Gap down another 3 to 4%. Monday morning jewelry stocks. Crash 10.15%. Titan PC Jeweler, Tribe Hovandas, Bimji Zaveri. Consumer response. Wait for prices to adjust before buying. Trader response. Some might buy anticipating smuggling demand. Scenario 2. Budget reduces duties. Announcement. Duty cut from 6% to 4%. Immediate impact. Rs 2,500 reduction per 10 grams gold ETFs. Rally 2-3% despite global weakness. Jewelry stocks. Rally 5 to 10%. Consumer response. Rush to buy at lower prices. Trader response. Relief rally in MCX. Scenario 3. Budget keeps duties. Unchanged. Announcement. Status quo at 6%. Gold ETFs. Track global prices. Likely gap down 9% from Friday. Jewelry stocks. Mixed, depending on global gold direction. Consumer response. Uncertainty remains about whether to buy. Trader response. Focus returns to global factors. Warsh. Fed. The wild card. What if budget is delayed or unclear? Sometimes budget speeches don't clearly announce duty changes, leaving market in limbo. This would be worst case. Continued uncertainty, no clarity, volatility persists. The jewelry chain inventory crisis. Let's talk about what's happening across the jewelry supply chain. Refineries bought gold at Rs 180,000 plus to refine. Now market price is Rs 138,634, sitting on massive inventory losses. May have to sell at a loss or hold and hope for recovery. Wholesalers. Similar inventory loss problems. Working capital tied up in devalued inventory. Banks may demand additional collateral for gold-backed loans. Some might face bankruptcy if they're highly leveraged. Retail jewelers. Showroom inventory purchased at high prices, making charges already added to pieces. Can't sell at current gold prices without huge losses. Customers not buying, waiting for stabilization. Cash flow crisis as working capital evaporates. Consumers. Some who bought at peak are sitting on 25-30% losses. Those who haven't bought are paralyzed by fear of further drops. Wedding purchases might be delayed if possible. This is a crisis cascading through every level of the industry. The survival guide for Indian bullion participants. Based on everything we've covered, here's practical guidance. For MCX traders, if you're still holding leveraged positions, check margin immediately. Consider closing positions voluntarily rather than waiting for forced liquidation. If you believe in recovery, switch to physical or ETFs. No leverage. Accept that stop losses won't protect you during weekend gaps. Never risk more than you can afford to lose on MCX futures. For physical gold holders, don't panic sell now. GST and making charges mean you lock in huge losses. Hold for at least 1 to 3 years to allow recovery. Consider it forced long-term investment. Don't buy more trying to average down unless you have genuine need, wedding, etc. For ETF holders, check your ETF's NAV versus market price. Monday, if trading at significant discount, 2%, consider waiting for normalization. If you need to sell, use limit orders, not market orders. Remember, gains are taxable, STCG or LTCG, depending on holding period. For jewelers, inventory. Don't dump at fire sale prices. Market will eventually stabilize new purchases. Wait for budget clarity before committing. Cash flow. Communicate with banks about loan collateral requirements. Customers. Be honest about volatility. Don't promise prices won't fall more. For prospective buyers, if you have genuine need, wedding in 3 to 6 months, start scaling in. Don't try to time the exact bottom buy. 25% of what you need now, 25% in a week, etc. If you're just speculating, wait for signs of stabilization. For everyone, watch these signals. Budget announcement, most immediate. MCX open interest. Declining suggests forced liquidation ending. Physical demand in Zaveri Bazaar. Chandni Chowk, anecdotal buying interest. Import data, are imports declining or rising? Global gold stabilization, is the Warsh-Fed panic subsiding? The bottom line budget day 2026 brought another 9% crash in gold and silver on top of Friday's catastrophic losses. Total damage. Gold down 28% from peak, Rs 54,462 per 10 grams. Silver down 37%, Rs 154,396 per kilos. The timing couldn't be worse. India's jewelers and consumers are paralyzed waiting for the finance minister to announce import duty changes. Will duties increase, making gold more expensive, decrease, cheaper, or stay the same? The uncertainty amplifies the global crash. Traders don't know whether to buy before potential duty hikes or wait for potential cuts. The weekend gap meant MCX traders trapped Friday couldn't exit, watching global gold fall with no recourse. Stop losses were useless. Positions gaped down, Rs 13,711. ETF holders face another reset Monday as equity markets catch up to weekend commodity losses. MCX limited stock fell 9%, a paradox given the record trading volumes volatility creates. The jewelry trade faces an existential crisis. Massive inventory losses, cash flow problems, consumer reluctance to buy, and policy uncertainty on budget day. Historical context. Current 6% duty is low by standards of 2013-2019, when 15% duties drove massive smuggling. But any increase now could restart that cycle. Monday brings 3 scenarios: duty increase, disaster, duty decrease, relief, or unchanged. Uncertainty continues. For participants, check margins, don't average down, wait for budget clarity, use limit orders, and remember physical gold's long-term value even if short-term is brutal. The worst 2-day sell-off in precious metals history happened to coincide with budget day, creating a perfect storm of global panic and local policy uncertainty. If this budget day analysis helped you, hit that like button and tell me, what do you think the finance minister will announce on import duties? This has been your guide to the budget day bloodbath. Thanks for watching, and I'll see you in the next one.